Welcome to Mongo Spaces this Monday evening. Our discussion today is about the Kenya Pipeline IPO. So we just want to get as much information as possible to help us make a decision about investing with Kenya Pipeline. So to help us do that, we have two guests. We have Joe Sang, who's the CEO at Kenya Pipeline, and we have Belgrand, who's the lead transaction advisor on this IPO. I will get started by allowing them to introduce themselves. So I'll start with Joe Sang. So we can tell us a bit about yourself and what you do.
My name is Joe Sang. I'm the managing director of Kenya Pipeline Company. I've been in office my third year. I've experience in finance, mainly from FMCG, as well as brewing. In my previous experience, I worked in Munga, I worked in South Africa Breweries, where I was for close to about 10 years, and National Corporation, and Kenya Pipeline is a GM Finance. So cumulatively, close to 25 years of experience, married with 3 children. I'm an avid golfer, single-handicap, as well as a marathoner. I do run for a purpose. I run to give back to the society and support underprivileged children to go through school. So under Joe Sang Foundation pillar. So that's what drives me as a partner is to make a difference and leave a legacy in this world.
About running, why do you run when no one is chasing you?
That's a very interesting question. So for me, I discovered way back that I can actually run. About 10 years ago, I used to do 10K, 5K. Last year, part 1, I discovered that I can actually do longer than that. I decided to stretch it a bit and did 30K. And I registered for a major marathon that was in Chicago. And after registering, I then asked myself, running to keep fit is good, but what's more important is looking back to my background, which is with run the school way back in primary school. My primary school is, I come from a place called Kericho, at school called Cap Masters. So it's about 4 kilometers from my home. We'll run the school in the morning, come back home for lunch, go back in the evening. So I discovered that there's still many kids out there who need help in terms of support. So my running then was going deep inside me to giving back in a small way. As Joe Sang. So I have a foundation with the Digital Trust, which I do support on the side. And today we have 12 children from across Kenya. We are supporting in terms of school. We cover their tuition, and this is extremely needed. Recently, we took a boy to Lenana, who happens to be a son of a young girl who does what you call carding at a real golf club in terms of day-to-day, and she could afford to take that child to school. We are also building a classroom in a school in Kitui, a place I've never been to. So it's something that gives me motivation to give back, not necessarily to my home area, but really to touch every part of the country in the coming years. So really, that's what motivates me to run.
Belgrand, over to you. Tell us a bit about yourself and what you do.
Thank you and good evening, everyone. And thank you for making the time to join us today. I think mine is similar. I enjoy running, but then I'm an investment banker by training and by practice, 17 years now. At FIDE, I'm the team lead in this particular transaction. FIDE Investment Bank is one of the largest investment banks in Kenya and in the region, with an office in Rwanda as well. So there's a regional representation. The bank has been involved in large transactions in this country going back to 2008, where they were the lead sponsoring stockbroker in the Safaricom IPO. Today, we're talking about the lead transaction advisor in this particular issue. And we look forward to engaging with Kenyans. Thank you.
Belgrand, just to put it in proper context, when a company is going towards listing or coming to market, usually they need to be handheld in such a way with a transaction advisor and all those kind of professionals. So what role do they usually play in that process so that we can set context for Kenyans to understand your role?
So transaction advisors will refer back to the market. So the market is made up of what we call buyers and sellers. In simple format, that's what you have. And then in the middle of that, we have what we call financial intermediaries or transaction intermediaries. These are typically licensed professionals, I would say licensed institution. In the case of a transaction of this nature, that would be an advisor licensed by the Capital Markets Authority to actually accompany the issuer into the market, but remaining pretty much neutral, because when we say you're in financial intermediation, it's actually trying to bring the issuer, or in this case the seller, and the buyer, in this case the investors, together in all transparency and following regulations that are set. So typically you find a transaction, an IPO specifically, speaking about this particular case, will require a licensed advisor of this caliber to intermediate a conversation between investors and the issuer, that is KPC in this case.
So to get started, Joe, could you tell us what Kenya Pipeline does?
I'd just like to give a quick highlights of who Kenya Pipeline is, what we do, and the journey for the last couple of years. So Kenya Pipeline is 52 years of age. It's owned by the government, 100%, commercial enterprise, incorporated on the 15th of September 1973. And we started our commercial operations in 1978 with 2 employees. Our core mandate is to transport, store, and deliver bulk petroleum products from Mombasa all the way to the hinterland. Our vision is to be Africa's premier energy partner. The mission is safe delivery of quality and sustainable energy and integrated solutions to our stakeholders with utmost care. In terms of the infrastructure, how we are laid up, we basically follow the artery of the railway from Mombasa all the way to Kisumu. We run 1,342 kilometers of pipeline with storage depots situated in Mombasa, that is Kipevu Oil Storage Facility. We have Kenya Petroleum Refineries, which is now a subsidiary of Kenya Pipeline Company. We have the Moi International Airport, the Nairobi Jomo Kenyatta International Airport. We have depot in Nakuru, Eldoret, and Kisumu. Together with the loading facilities in those 3 depots, we have the hydrogen system that support the loading into the planes at Jomo Kenyatta International Airport, as well as the Moi International Airport. In terms of the storage capacity, today we post as a country, we have close to about 1.1 billion liters of petroleum products, again spread from Mombasa through to Nairobi, all the way to Nakuru, Eldoret, and Kisumu. We also have a jetty. We operate jetty operations in Kisumu, where we use the natural resource, which is the lake, to transport petroleum products from Kisumu to a place called Mahathi in Entebbe. And to date, we've done close to about 850 million liters of petroleum products, and therefore saving the roads in terms of damage, as well as reduce the carbon monoxide that is emitted by the trucks. In terms of the market that we serve as a company, so basically for us, as I said, our core mandate is to store, transport, and deliver. We have what we call the transport and storage agreements with our oil marketing companies. And today in our database, we have close to about 140 of them, which are spread in the region. And in Kenya today, our market share is about 94%. In Uganda, we serve that market through our oil marketing companies at 97%, which is close to that entire market. At the eastern part of DRC, we serve 72% of that market. The South Sudan, we serve 73%. And Rwanda, this market, after the famous post-election violence he had in Kenya in 2008, we lost that market to Tanzania, but now we've regained it back. We are now at 10%, and we are looking to grow. Burundi, we do 1%, and we have small parts of Somali as well as the northern Tanzania. We transport close to about 10 billion liters of petroleum products using the pipeline. And now we make our revenue is, we are regulated by EPRA, which is the Energy and Regulatory Authority. And it's on a tariff control period on a 3-year basis. And we do then charge what you call a tariff on the throughput, which is the volume we transport using the pipeline. And we get certain from parts of our revenue. And then in terms of the cost structure, then you have the staff cost, depreciation, taken to the bottom line. And now people know that this is one business that consistently, and I underline that one, it has consistently delivered a dividend to the shareholder, which is the National Treasury, as well as taxes. In fact, the dividends contribution in the last 4-5 years is to the tune of 24 billion shillings. When you compare with the taxes, it goes closer to about 45-50 billion. And that is something we're very proud of as a company in terms of helping the country from a business point of view. We have consistently delivered great performance year on year for the last 5 years. We've qualified, in other words, key audit opinion from the Office of the Auditor General for the last 3 years. The last one being last year, June 2025. And even this year, we look to get a clean one. So this is a business that is well run, a business that I can say I'm very proud to lead as a captain. It's a business that has talented employees. We have employees of this business who are very, very great assets. These are employees who are able to have expertise nowhere else you can get in the region. We have engineers that are able to wear a pipeline when it's moving with very hot products, flammable products. And this is something that we are starting to maximize in terms of how do we export talent as well as offer services to our region. I'm happy to know that we also have a school today that's called the Moreland Institute of Oil and Gas that is able to support in terms of capacity building, matters welding, drilling. We've partnered with a number of counties in our republic, and we've also offering consultancy support to neighboring countries. Recently, we signed with Congo. And finally, a very important pillar which I want to call out, which many people don't know so much about in Kenya Pipeline, is our soft side. The soft side of KPC, which is, and I'll just mention about 3 of them. The first one is about a program that we have. It's called Inuka. Inuka is a Swahili word for uplift, where for the last 7-8 years, we support students who are enabled differently across our republic, a boy and a girl. In total to date, we've supported 839 students to go through school. We pay for their tuition, we pay for their upkeep, we pay for their transport, and every year we take 94. So meaning a boy and a girl from the 47 counties to go through that school. This is something we are very proud of. Last year, around April, we then introduced a program called Inuka Plus. Those who are going through what we call the tertiary as well as the university. We have 25 of them in our program today. And I would like Kenyans to know that out of the 25, we actually have 5 of them are doing medicine. These are people who are unable to work. They use wheelchairs. And we are very delighted that they're helping in terms of showing the soft side of the human side in a pipeline.
Maybe we'll come back to impact a bit later on business model. I wanted to understand perhaps how you make money and who are your key clients. That's a key concern that you've received from some of the questions that our audience have been sending in.
I talked about the ones who regulate our tariffs. So we are the transport and storage agreement, because the TSA, this is a commercial agreement with our oil marketing company. So for every volume that we move, we then apply a tariff. And for the volume, we call it throughput. So instead of a service fee for handling, storage, and transportation, that constitutes 95% of our revenue today. The 5% we have other revenue streams, and this is mainly the fiber optic business, where along the 1,342 kilometers of pipeline I talked about, we have what we call a dark fiber, where we've listed to, it does about 90 scores. We've listed the big telcos. Safaricom, for instance, uses our line from Mombasa to Nairobi as the backbone for their data. So that's the FOC, contributes a lot financially. We are about 400 million Kenya shillings. And we have other small revenue streams, which is mainly from the school as well as late penalties. But I'll say the bulk of our revenue is actually from the volume which we charge the oil marketing companies. And the oil marketing companies are the Vivo, the Ruby, the Total, etc.
So your business is B2B, so to speak. So you charge the oil marketing companies, that's your key source of revenues, if I get that correctly.
Correct.
And then in terms of key cost items, you mentioned a few, maybe you can reiterate so that people can match your revenues against your costs.
So the big cost item for us would be the maintenance, because we are heavy on infrastructure. I talk about pipelines of over 1,000 kilometers, storage capacity tanks. So we do maintain. So maintenance cost is a big one. We also have the staff cost, which is the cost of employees to be able to keep the business running. Of course, we have the depreciation costs. We have the cost of electricity. Electricity for us is quite big. We pay that company, Kenya Power, close to about 250-300 million a month. That comes about almost 3.5 billion shillings in a year. That's a significant cost in terms of our P&L. So mainly, I'll categorize our costs as the direct costs, which are mainly the maintenance, the staff costs, utilities, which is mainly electricity, and then depreciation.
And then in terms of gross margins, from your key numbers from 2021 to 2025, I see an average around 56%, and net margins around 12 to 13%. So pretty impressive in terms of growth over that period. But then going forward, you projected that fiber optics will be a key source of revenue in the future. So could you maybe take us through your projections going forward on where you expect to expand to in terms of revenues and all that?
That's a very good question. I'll break down the future plans into 2. First, I'll start with the existing business. The existing business today, from our analysis, there's still huge potential to tap into the top line. Today, as I talked about, Rwanda at 10%, South Sudan 73%, and DRC at 70%. There is still potential to grow the top line. So that's our key focus. We were in Rwanda last week. We are getting the maiden cargo from the month of March to be able to show up that number from 10%, hopefully, Our target is in the next 2-3 years to be able to have at least 50% of the Rwandan market. So the huge potential, especially in the region, I'm sure the audience will appreciate this. If you look at the GDPs for the region, today, Kenya, we are doing about 5%. Uganda growing at about 7%. Rwanda, the same, about 7%. And therefore, the petroleum sector always grows in tandem with the GDP at about 50-60% of it. So we do expect the top line to continue growing. The second one is about optimization of our facilities. I've talked about Kenya Petroleum Refineries. It's sitting on 377 acres of land in Mombasa. We are looking to be able to optimize that facility and bring in revenue stream into KPC. And one of them is we are looking to add the storage and do what we call a trading hub. Today we are serving close to about 5-6 countries in the East Africa region. And the trading hub is to be able to take advantage of the seabed and do what you call the backloading all the way to South Africa. And with KPRL, that's a big one we are seeing. The next revenue stream, which we also want to dial up, is the LBG. And this is something we have in the information memorandum, where we'll be setting up storage facilities mainly in Nairobi and Eldoret for integration to the last mile. And we are looking at that in the next 5 years to be able to give us close to about 2.5 billion shillings. The fiber optic, which is what you talked about. Today, our fiber optic is what we call dark fiber, which is a hollow pipe. We want to put in what we call the active equipment into it. And today, the revenues from fiber optic is about 400 million Kenya shillings. We are looking to increase that number in the next 5 years and to be able to move to about 2-3 billion shillings. And this is because of the lighting. We'll be able to take the fiber into the ISPs. Not only the big telco companies, the Safaricom, Airtel, MTN, we'll also be able to work mainly with the ISPs in terms of wholesale. So we believe that would be a very good revenue stream for us. The last but not least is the Eldoret Kampala line, and later on into Eldoret Kigali line. We're also targeting to increase the expansion plans into those markets and be able to get additional revenue. So if I summarize for you in a nutshell, KPC into the future will be about diversification. Diversification into different aspects of the business. Today, 95% throughput from the core business, which is petroleum, from 95 to 80%. The 5% we want to increase that to 20%. And therefore, the 15% incremental will come from the fiber optic, it will come from the LPG, it will come from the trading up, and last but not least, it will come from the Eldoret Kampala line.
I'll give you a bit of a break, so I'll switch to Belgrade. So Belgrade, you can give us a bit of context on how the process has been of taking a Kenya Pipeline to market so far. What was involved in that process, and what does a lead transaction advisor like you do, and what's your input in such a process?
As a question, it gives me a perfect opportunity to actually just take us back to the origin of this transaction. That started way back in 2009. Now, if you look at the Gazette notice in terms of the privatization program, the process started way back. I think it's opportune for us to be witnessing history by being those involved in this momentous occasion. With that, pretty much, if you look at the privatization process, it starts with a program, and then you have a cap memo that goes to the cabinet for approval. And then with that, it goes back to Parliament. And then with Parliament now approving through what we call the sessional paper, which is a reference, a framework document, sessional paper number 2, 2025. Then with that, then the Privatization Authority is the agency of government mandated to implement this particular process. So with that, then I think they went ahead to recruit transaction advisors. And we're talking about a full team, a multidisciplinary team, where you have legal advisors, you have the reporting accountant, you have a registrar on board, you have a lead sponsoring stockbroker. Really, broadly speaking, we talked about 64 advisors within, I would say, give or take 12 firms. So it's a whole team. And that is why typically you'll be referring to Fight Investment Bank as the lead transaction advisor. Of course, going by CMA regulation, that is the public offer listing and disclosure regulation, there is a requirement for transaction of this nature to be conducted with the guidance of this. Now, specific to that particular process, we started with what we call a due diligence exercise. Upon contracting the advisors by the Privatization Authority, our job was to confirm everything that Joe has said. He's told us about many things, and for the advisors, you find that the legal due diligence was very robust, or the financial due diligence equally robust, the technical due diligence. We had experts and professionals traversing our country looking at the assets of KPC, just reconfirming the existence of those tangible and putting a value to it. We had tax due diligence being conducted. When Joe talks about the company being well run, we had to reconfirm that through operational due diligence. So really, there's been a lot of work put in by our team, and I take this opportunity to commend the various professionals who were involved in this transaction. Once you have that going, then as a result of the due diligence, then we would put up a disclosure document, which is in the form of an information memorandum. And that is what has been availed to the public with supplementary information, which is what we're listing as documents available for inspection. So with those disclosures, then also it was required of us to place a value before we go to market. So valuation was conducted, and it's a topic we've talked about. I'm sure we'll talk about it again. But then really, because I've been given an opportunity to speak to the process, I will say that when it comes to due diligence, we can confirm that we're dealing with a unique opportunity before Kenyans. It is historical. Looking at the maturity of the assets, the barriers to entry that it enjoys, the monopoly that it enjoys, the growth that we've witnessed in the past, it's been tested. When we say this is a high growth business, people will wonder, 52 years old, are you still talking about growth? We're more than happy to spend time demonstrating to Kenyans that the story should not be solely about dividend. It should also be about putting your investment where you believe and you can see that this value will grow into the future and possibly even double in value in the next 4 to 5 years. So when Joe talks about the outlook of what the company is likely to do, we quickly believe in him, because if you look at the history, this company has grown at a CAGR, compounded annual growth rate, of 8.4%. So when we look at that CAGR for 5 years, we compared it with Safaricom, and we quickly saw that Safaricom grew at 8.8% over the same period. If you recall, during that period, we had COVID. And COVID did not really favor KPC, because in terms of throughput and consumption of fuel, we were talking about lockdowns and things like that. Whereas for Safaricom, the difference here is that there was increased usage of data and so forth. So when you look at that 5 years historical from a growth perspective, a company delivering 8.4% within the control of government, and in difficult times such as COVID included in that period, I can tell you when we then took it to about 3 years, looking at that particular growth, it was 13% CAGR. What am I saying? That we're not telling Kenyans to buy into a dividend play only. We're talking about buying into a growth story. And that, when I listen to the CEO talk, our job as market intermediary is not to take side. I want to really reconfirm that. I keep saying we're professional, and what is required of us is full transparency and neutrality, avoiding conflict of interest, and our sole mandate is to ensure that this transaction is conducted according to the Capital Markets Authority's regulations specific to what we're calling the POLs, which is the Public Offer Listing and Disclosure Regulation. So our job, and I really want to assure Kenyan, is to make sure we bring the parties together on an arm's length perspective, and due diligence actually helped us to confirm that indeed the business is an opportunity to Kenyan, both from a growth perspective and also from a dividend perspective.
Well, Grant, maybe take Kenyans to the key details of the offer itself. What's on offer, especially summarizing the key aspects of the info memorandum.
In terms of offer, again, this company, from a process point of view, the disclosure talked about 65% being tendered to the private sector. That's the mandate that was given to us by the sessional paper, number 2. And the 65% equivalent is what we're calling the shares in offer, which is equating to 11.8 billion shares. The total shares issued, 18.1 billion. So when you do 65% of that, 11.8 billion shares that we're talking about. So at all times, we're saying the traditional owner of KPC, that was the CS National Treasury, holding it in trust on behalf of all Kenyan, is now divesting in part at stake to actually allow investors to own up to 65%. That corresponds to the 11.8 billion share that we're talking about. Specific to the offer share, there's been, as required by the code regulation, there's been pools in terms of allocation that has been disclosed in the IM, where we're saying investors will be prioritized in terms of pools. And when we talk of pools, then we have typically 6 pools. Starting with the employees of KPC, we're seeing 5% of the 65% being allocated for KPC staff to access this opportunity as a way of priority. It's more of a priority. We do not want to confuse this with ESOP. We've seen a couple of questions coming around. The 5% is purely a pool where we're giving and we're ring fencing out of the offer share 5% for employees to access. Then the oil marketing companies have been allocated a pool where 15% is the ring fence for them to access in priority. And then we have our local retail investors. Retail investors, typically individuals like you and I looking to invest, the allocation here is 20% of the 65%. And then institutional investors, if you look at the IM, the definition is qualified investors, typically your insurance company, your pension funds, and the likes. So institutional investors of this country have been allocated 20% of the 65%. And then we have our regional stakeholders, as KPC is a significant regional player with 52% of its revenue drawn out of the region. That's what we call transit markets. The CEO has talked about Uganda being an important market for KPC, but also Rwanda, South Sudan, Burundi, and Eastern DRC. So for the region, except Kenya, so all EAC member states except Kenya have been allocated 20% of the 65%. Last but not least, we're talking about foreign investors, and this category has been allocated 20% as well. So fairly balanced, fairly distributed. That really responds to the principle of fairness, equity, and transparency. Of course, inclusivity as well, where we're allowing this national asset to be broad-based in terms of ownership, where we're looking keenly at inclusivity. And I want to really state that our objective and our wish is to prioritize Kenyan. In all conversations that we have, we would like Kenyans to take the lead in owning this particular asset, not because of patriotism alone, but because we see significant opportunity when it comes to your long-term investment, because we keep telling Kenyans, this is not forex trading. This is an investment where you should take a long-term view to the growth that we've talked about. That growth, should you come in today, you will be taking full advantage of that particular opportunity. And we would not want to sit and watch institutional take a priority where our key objective is to ensure that the ordinary Kenyan take advantage of this particular opportunity. So in terms of offer, I would summarize to say the 65% is allocated across those various pools, but then specific now to the price, we're talking about a price per share of 9 shilling. A lot has been said about 9 shilling.
That's been key. 190 are looking at 9 shillings and they're wondering the valuation, how is that arrived at? And whether that's too steep in terms of the asset that you're bringing to market and whether it allows also for an upside, given that it's pretty almost at the high end of the EV/EBITDA multiple around 8 or so. So perhaps, Belgrade, you can take us through your thinking around the valuation process that ended up with the 9 shilling as the offer price.
When we say 9 shilling, that's a nominal price. So that 9 shilling, it could be priced at any other level. So when we say steep, for those who have said that, I want to be very clear that first and foremost, we wanted the pricing of this issue to be affordable to the ordinary Kenyan, the pricing. And then we'll speak to the valuation. So you find that the 18.1 million shares that were issued and outstanding were actually multiplied to 1,000. So that we arrive at 18 billion. Looking at the value, then when you divide that, you will be getting a single-digit price, which is also in line with the previous IPOs that we've witnessed in our country, looking at Safaricom at 5 shilling and others. Now, specific to the valuation, a lot had been said about it. And I think the misconception here, and I really want to talk about it, is pricing out the growth potential of KPC. I think most analysts and most ordinary quote-unquote analysts will look at it purely from a dividend play or from multiple perspectives. And I always say in all my engagement that this is pretty much a growth stock. And you find at the exchange that there are actually companies that will even pay you lower dividend than what KPC is paying, and they will still be attractive. And I normally speak about the NSC even as a platform and as a company. So when we say steep, I think my assessment of the comment, which for the most part are misadvised, is purely looking at this opportunity from a dividend play or from a comparative to some of the companies that perhaps we should not be comparing with. I want to spend a bit of time explaining that this company has significant growth potential that we've barely seen in our capital markets. This company has significant margins that we've barely seen in our capital market, because when you look at the growth trajectory, I keep referring to Safaricom because we all know this is our bluest cheek at the exchange. And I've shown you the growth of Safaricom vis-a-vis the growth of KPC. And going into the future, outside the government bureaucracy and the various initiatives that the CEO has talked about. So at all times, I want to invite Kenyans to actually price in the growth opportunity that KPC represent. They have been misadvised to purely look at it from a dividend play, claiming that this is a mature asset. This is a mature asset whose potential is unleashed. And coming out, we've talked about looking at certain markets, whether it's Rwanda, South Sudan, or Burundi, and then erasing that particular conversation where today KPC is barely providing 10% of the needs of the Rwandese market. There's an agreement that's being signed that will move the 10% to about 60, 70, and all the way to potentially 80% into the near future. So what that does to throughput is an increase in throughput. We've talked about South Sudan as a market. Again, an increase in serving that market would mean increase in throughput. When we look at KPRL, that's the Kenya Petroleum Refinery Limited, coming into the books of KPC. They barely scratched the surface as to what this asset can do to the top line. So when we sit and assess just from a core business perspective, what this company is able to deliver in terms of growth, that is significant. Beyond the 8.4, we're seeing a double-digit growth purely on the core business side. The CEO has also talked about diversifying its business from 95% of the core, taking it down to about 80%. That means the diversified business, what we're calling the new business, will represent around 20% of KPC revenue. And when we talk about 20%, these are high-margin new businesses. So the fiber optic cable has already been installed. So when you look at that cost, it's significant cost is being incurred already. So when revenue comes, it means a marginal increase in your bottom line. So for us, looking at fiber optic, looking at LPG as a new business into the diversification, it enhances the growth story. So really, before I come down to the metrics of valuation, that can be technical at times, I want to tell Kenyans that we're talking about a growth stock where you're going in to buy actually in a capital appreciation opportunity. This to us is a message I wish we can pass across because we're able to demonstrate on the P&L how that will actually drive value to the bottom line, not only in terms of dividend, but also in terms of price appreciation. I think that is important before we start saying, oh, this is technical, this is how these things are measured. I believe we are speaking to the ordinary Kenyans, and I do not want to jump into technical metrics without making sure they understand that the comparison that we've been dragged to is unwarranted. So it's actually misinformation.
If you look at Safaricom itself, it's trading at 16x PE, but Kenya Pipeline is coming to market at a PE ratio around 22. Don't you think that's a steep pricing, even if like you're comparing it to Safaricom? And then what are the peers that you've looked at in terms of the bracket within which Kenya Pipeline operates, especially if some people have compared it, let's say, to Kenya Power and all those others, and the market's still pretty steep. But do you look at other peers perhaps in other parts of the world to also get comparative pricing? And I feel like Safaricom may not be the best in terms of comparing. And even if you look at that as, again, I said 16 to 22, could you help us think around that also then?
It's a very straightforward answer because Safaricom today, if you compute that PE, it's going to give you 17x. Now, KPC, for the audience in the room, KPC's financial year ends June 30th every year. So we're actually 4 months into the end of the financial year. In the information memorandum that we've provided to the general public, we have what we're calling prospective financial information. And we've already passed H1. So it would be fair for those analyzing the books of KPC to actually look at the 4 months that are remaining. And you and I are analysts, so we can quickly talk about what we call the forward PE. Now, that forward with the 4 months remaining, we've talked about a top line of about 41 billion expected as at June 30th, 2026, with a bottom line of 9.6 billion. Now, if you go by that and assuming a constant price, then you can compute that PE quite quickly in terms of ratio. It will give you 16.9. I've told you Safaricom is at 17. Now, I want to pause before even looking at peers outside to tell you that the reason why there is a significant relevance to comparing these two is because of the nature of the business. We're talking about a capital intensive business. From a governance point of view, which is unlike the KPLC and KPC, Safaricom, yes, they are going through a transaction now, but then typically, if we brought KPC today, before they complete the transaction that's ongoing, we'll be talking about 35% government shareholding in Safaricom, very similar to what you're seeing in KPC. That's 65 private sector and then 35% government. Now, the conversation is even sweeter now because when you look at your typical comparative analysis, you typically would be adjusting for those metrics that are driving value. A lot of Kenyans would sit and say, if your PE is 17x, it will take you 17 years to recover your money. Far from it, because I keep saying when you're growing faster with higher margin compared to another stock that's growing slower or with lower margin, your recoverability of the investment amount is much faster. And that is why, in terms of growth and margin, we're saying we're looking at like for like growth for Safaricom being similar to growth of KPC in the past, where we are confident that growth of KPC into the future will be significantly higher than Safaricom. And we've demonstrated why. Now, when it comes to margin, you can check, and we have analysts in the room, the EBITDA margin of Safaricom stands at 50%, and the EBITDA margin of KPC is at 49%. Into the future, we're seeing that averaging 50%. And I'll tell you why. Because going outside government, you've seen even in the information memorandum, the expenditure in 2025, court case in terms of award, in terms of penalty, in terms of extraordinary expenses like the decommissioning costs and stuff like that, that are outside the ordinary course of the business of KPC. When you normalize that conversation and you factor in efficiency going forward, where management will be telling you they have a lot lined up in terms of making their cost structure even more efficient, despite them today being the most efficient company within the GOEs. And of course, that explains why that efficiency is reflected through high margin. So what we see is by the time we're comparing it to Safaricom, it's the large cap nature of this business, the capital intensive nature of the business, the governance structure of the business, the growth pattern of the business, the margin of the business, and even when you go to ROE, similar pattern. And that, when you say 17x is where Safaricom is trading at, we feel that the fair value estimate of KPC actually gives us room for an upside, considering its growth is significantly higher. And by the way, the book value multiple of KPC is at 1.7x. And the book value of Safaricom, if you check, is at 5x, or 5.3, 5.4x. So significant. Now, that was purely on Safaricom. You've asked about peers. I want to demystify this issue of KPLC and Kengen and even Total. I've said it before, and this is an opportunity to say it again, that we cannot be comparing a KPC, first of all, with Total. Total is competing with 145 other oil marketers. I could have jumped on this opportunity to say Total PE today is at 16.5x and quickly say it's pretty much close to what we're talking about. I do not want to go there because just going by the nature of the business of Total, it is at a downstream play compared to a midstream, but also there the margins are very thin owing to competition. The net margin of Total today is below 5% compared to 24% net margin of KPC. But more importantly, if you look at the market capitalization, that is the total value of Total in the market today. It's barely 6 billion shilling. We've told Kenyans over and again that we're talking about a cash-rich, debt-free company. That cash rich is sitting on 16.2 billion. With 16.2 billion, how many Totals can I buy? So not only we're talking about a very low margin business at the downstream level, but also from a size and competition, we wouldn't want to compare that. Then we come to KPLC. Again, KPLC, if you look at the capitalization of KPLC today, it's around 29 billion owing to a book value that has been depressed. We were speaking to American investors today, and when we started the valuation conversation, we tried to bring KPLC on board. They quickly said, no, you cannot compare the two. Because by design, the governance structure of KPLC, the business model, very different. Speaking of margin, equally different. So when we saw Kenyans actually dragging the conversation into KPLC, where the PE is about 1.18x. So I kept asking the audience, why is it that then if we're trading 1.1x at a PE level where you can recover your money within a year, why is it that not all Kenyans have lined up to buy KPLC? Of course, because they understand the structural imbalances and constraint of KPLC and all the way to the growth that is not happening. Thin margin, unlikely growth, and also significant challenges when it comes to its business model. And last but not least is Kengen and KPLC. These are the twins. They're tied at the hip. You cannot talk about one without the other. So what affects KPLC structurally actually would affect Kengen. Much as the EBITDA margin of Kengen is at 60%, Kengen is not growing. It's not growing. We're talking about a CAGR of 2%. Compare that with the 10-13% we're talking about when it comes to KPC. So really, I also say that these three companies, be it Total at 6 billion total value, or KPLC at 29 billion total value, or even Kengen at 63 billion total value, combined, that total valuation is nowhere near even the tangible asset value of KPC. So for us, we do not want a situation where, because companies at the Nairobi Securities Exchange have been priced at 25% of their worth, owing to several challenges, we cannot take that and say because we are comparing within the energy sector, we're going to price KPC coming to market at 0.25x. This is a public asset with significant value prop. The least is to look at it from a book-to-book value, and that's what was done. Now, lastly, as I conclude, we talk about then pipelines around the world. Where did you look at and what came about? The conversation is very simple. Regionally, we do not have a pipeline we could compare KPC to. It is a monopoly, not only in Kenya, but also within the region, which is a significant upside for any investor looking into the future because the barriers to entry are significantly high. So we went out, and you find that in emerging markets, markets such as India, we had several pipelines. When I say several, it already tells you about a weakness in those markets, because here we're talking about one and only one pipeline. So that monopoly comes really at a significant value. Now in India, we're talking about 3 pipelines. We narrow it to 2 that closest match the business model of KPC. And looking at those 2 pipelines, we were very specific as to how we would price that in. And similarly, in the US, we took about 2 pipelines as well. So if you look at the sample size, it's a sample size that is blending your emerging market operators and also your developed market operators. Why is that important? So that we neutralize the geographic impact of that comparison. So that first of all, like for like, we compare this pipeline and then we adjust for the country risk. And those were averaging in terms of trading multiple. The average was 9.1x. And so we offered this at 8.1, which is at a significant discount of 12% compared to the averages because of adjusting for what we call the country risk and perhaps even looking at access to capital in some of those markets being favorable to some extent. Now, something else, so that I conclude, these companies that we're comparing KPC to, if you look at them, you'll find that KPC has been growing faster than any of its peers. It has higher margin than any of its peers, and we're talking about a balance sheet that's much stronger. To summarize the opportunity, we look at the high growth, high margin. We look at the opportunity of investing into a monopoly with defensible, predictable cash flows. We looked at the dividend play that is constant into the future. We looked at the strong balance sheet. The CEO talked about the human capital, the systems. So looking at all that, we are fairly confident that any Kenyan putting their money into KPC as an opportunity is not just playing for dividend. You're playing for growth and you get value for your money.
And Belga, if you could share that, especially the slide on valuation with us a bit later, so that you can also have a look at the companies that you mentioned. Is that okay?
Absolutely happy to share. I think my colleague Rina, you're here. If you can, kindly just make those slides available to Mango team.
Back to you, Joe. I wanted to reiterate maybe a couple of things so that you can buttress them. One, dividends. You're promising to pay dividends. Could you talk a bit about the dividend policy, how it's been and how it's going to be? And then secondly, a bit about the company, who are in the board currently, how's the board structure, the management team, and the experience a bit about it. So you can summarize a little bit for the Kenyans so they can have a bit of perspective on how the company is run presently.
In terms of the dividend policy, our dividend policy currently is at 30%. We've seen standards which was approved by the board about 2 weeks ago. And going forward, we enhanced the policy from 30 to 50%. And this is 50% dividends means this is what will be paid out in the profit after tax. So basically for the year to be, I can assure you that the Kenyans or the investors who are coming in, they'll be able to benefit from the earned dividends at 50%. In terms of the second question you've asked, which is the board structure. Today, our board composition being a state corporation, we have 3 representatives one from the parent ministry, which is the Ministry of Energy and Petroleum. This is an alternate director, is the PS, Principal Secretary. We have the alternate director to the Cabinet Secretary and National Treasury. We have the alternate director representing the Attorney General. So those are 3. And then we have the independent director, starting with the board chairperson, and we have other directors. In total, there are 9 plus the MD, so we are 10. In terms of going into the future, I guess that's where your question is headed. As you're aware, the government is divesting 5%, so remaining with 35%. So we do expect in the coming months, the new shareholders will not be able to get that enhanced capital structure in terms of bringing in the board members, especially there's a position in the members that has been for the oil marketers. You'll agree with me, the oil marketers are a big stakeholder in terms of the pipeline because we operate in trust, we transport their product. So a position has been reinvented for them in terms of a direction. We've also reinvented a position for the fund managers. They're called the FMA. So they do have an association, and these are the NSF of this world, the pension funds. So those are the 2 positions that have been reinforced in the new, after the proposed board structure. And the government of Kenya will still retain the 35%. So that means effectively out of the 9 board members, the government will still appoint 3 through the Cabinet Secretary, National Treasury, and then the other directors will then be from the 5% pool. So we do expect to see changes in terms of timing. We'll get to know in due course. Again, this is in line with CMA. And as you're aware, the CMA rules talks about a third of the directors must be independent. And I'm pretty sure that will be the position going forward.
There's been a bit of worry also about Uganda setting up its own pipeline and all. Could you speak to the risk that comes perhaps from Uganda to your business? And then some other risks that you maybe have identified in the process of preparing the information memorandum also?
Good question. So I'll start with Uganda. As most of us are aware, the line from Oima to Tanga, and this is the crude oil line, close to 1,450 kilometers of the crude oil. They're setting up a refinery, but mainly the pipeline is for the crude oil. In Kenya today, you're aware, in northern Kenya, we have deposits from Talo, and now we have the new company is called Calf, who bought Talo, and they're also setting up to start the commercial exploitation of the deposits in Kenya to be able to export crude using our facilities at Kenya Petroleum refineries. So for Uganda, we are seeing refinery will take time. It will be in another probably 4 or 5 years before it's fully set up. And having said that, part of the reason why Kenya stopped the refining of petroleum products is it became economically non-viable in terms of competing with direct imports of refined products. And what we know from the analysts in the market is the oil in this region, especially the East Africa oil, is waxy. So it needs a lot of heating, and there's a lot of work to be done before you start using it. So we don't see the Uganda refinery being an immediate risk. However, in terms of what we are countering, I talked about earlier the diversification. In the next 5 years, we are looking to, as I said, reduce from the 95% reliance on fossil fuel, which is what it is today, to 80%, meaning we'll have improved from 5% to 20% on the alternative sources of revenue in the business. That will be big for us. We're also looking to optimize on the existing facilities, and one which I didn't mention about earlier, and probably this is a good opportunity to mention it, is today we pay a lot of money in terms of electricity bill, and we do hope to solarize most of our infrastructure to be able to reduce that cost. So we are looking at every cost structure in terms of efficiencies, in the future be able to cut down on some of those cost lines to be able then to run a very lean and agile P&L. So the opportunities there are many in terms of countering the risk. And more importantly, some of the benefits of moving into this process is actually, as a government entity today, one of the big challenges that we have, and we've seen it, and this is common with governments all over the world, is that the bureaucracy in government is very slow to get, for instance, the budget approval on time. And this has been a major setback in terms of moving quickly to market. Speed to market has been very slow. We've lost some opportunities. And therefore, with the new dispensation, which is moving from a government entity to a PLC, we are basically seeing a huge opportunity in terms of accelerated business growth and expansion into the diversification I've talked about. We'll be able to access cheaper capital in terms of the array of funding options, e.g. the bonds, the rights issue, in terms of motivating the great asset that I talked about, the employees. We are coming up with that employee share ownership structure. And therefore, this would be able to motivate and reward the employees and to move away from the employee relationship. It's what I'm calling it a partner owner. And it's more accountability and loyalty.
Some further questions, especially let's say on the board a bit. You've allocated seats to FMA and RMCs. Shouldn't you wait for the IPO process to perhaps be done and then you can see how to allocate? And if someone has a worry here around minority shareholders, how would they be protected? Would they have a say in the running of the business themselves?
Let me start with a question on the RMCs. We believe we've been a very, very big stakeholder because the way the transport and storage agreement is, we work in trust. We work in equal opportunity to all of them. So we want them to have a seat on the table. And that's what is informing the thinking in terms of having them sit on the board to represent that interest. We've talked about the minority interest. I'm very sure that will be part of that 5%, the remaining positions. And as per the CMA, as you're aware, probably an optimal board is between 9 to 11. I'm aware Safaricom is that they are about 9. So FMA and the OMCs and about 3 from National Treasury. Then if you're working with 9, you have 4 from independents. And I'm sure the interest of the minority will be taken care of. If you're working with 11, you have 6.
Someone else is also wondering a bit about electric vehicles. I mean, if a bigger uptake in the market, would that be something that can tend to lower perhaps consumption of petroleum products? Is that something that you're worried about? And then also, do you have any plan to tap revenues from Turkana Oil? Maybe build a pipeline towards that direction also?
And with the EVs, we are looking at it as an opportunity. We are basically planning to set up the EVs in our depots. And I talked about our pipeline operations stem from Mombasa all the way to Kisumu, following the artery of the railway, which is along the road. And we are looking to set up the EV charging points, and that will be a good revenue stream for us. At the same time, we're also looking at, in terms of the risk, is there a risk to the EVs? With the growing population and the growing GDP, we actually see the petroleum products, and we did this projection for the next 25 years. By 2050, we'll continue seeing the petroleum products demand going to go up in terms of gasoline and gasoline. So we don't see the immediate risk. By 2075, in the next 50 years, we are looking at that demand probably slowing down to by about 20%. And by then, with our diversification strategy, we'll be able to have business. Probably by 2050, we are looking at almost the 80-20 by 2030, about 50-50.
Belgrade speak about the risks and at the same time speak a little bit about how the process will be, the key dates, perhaps repeat the key dates for the public to understand when and where they should expect certain things. And you can also tell them what to expect after the end of the period of applying for the Kenya Pipeline share.
I want to take this opportunity to put this matter of Uganda as a market risk to rest because, again, it's all about misconception. We've gone to Uganda, we've just come back, and all indications are the same way Uganda has enjoyed a strong relationship with KPC over the past 52 years. I can tell you without fear of contradiction, that partnership is going to extend to the next 50 years. Let me repeat that. Uganda is going nowhere. It's been a lot of misconception because when we talk about an oil pipeline, let's make a difference between crude oil and white oil. Very important. Even in Kenya, we've talked about Lokisha, Turkana oil, we've discovered it, but no one is talking about a threat to KPC business because crude oil is not your final oil for consumption. So the conversation in Uganda is about crude oil. The refinery that they've talked about in the past is no longer in the picture. It is not commercially viable. Let's call it the way it is. I think everyone is trying to avoid this situation. When you look at the ECOP, which is the East Africa crude oil pipeline, which is actually taking the Ugandan crude oil into Tanzanian shores for export, the plan originally was to create a parallel line for white products. That was since abandoned. And when we say production of oil, that's crude oil for export. Then there will be a requirement to have a refinery. The same way as a country, we had KPRL, Kenya Petroleum Refinery Limited. This company closed down in 2013 because it was not competitive with its Indian counterpart or the global counterparts facing the same Indian Ocean. So the conversation about KPRL today, the same way we have crude oil, Uganda has crude oil. Now, refinery is not viable in our region. Let no one spread misinformation that this market is likely to see a threat from Uganda. We are talking about a partner that has taken a long-term view to be a significant shareholder of Kenya Pipeline, with a view of partnering to the next 50 years. So what that means is the Malaba line extension that you've seen in our plans, as far as CapEx is concerned, is so that from the border with Uganda, they extend that to Kampala. And eventually that extension will reach Kigali and potentially Eastern DRC, which is the largest market in the region. Uganda is not a threat. It is a partner. Today, KPC actually pretty much supply all their market needs. They have indicated to us that they are coming in for the long haul. There are significant plans to partner in terms of availing an additional line, the Malaba line, extending it to Uganda. I really hope this put this matter of Uganda to rest, because all officials from the Ugandan National Oil Corporation will tell you that they are into KPC to stay. They are coming in big as a shareholder. And the conversation, from what I have seen and heard, being involved, being at the center of those conversations, is a very long-term view to the partnership. So that's one. In terms of just perhaps strategic risk, as some will put it, it is not there. It is imaginary. It is non-existent. And really, for those who have listened, I want us to put this matter to bed. Other risk, I would say that execution risk is one that we may want to list here, because we're talking about an outlook that is significant. We're talking about a valuation that has considerably taken into account an outlook. But then we're talking about the company of the year. KPC, as of 2025, was voted ahead of Safaricom, EABL, KCB, and the like, as the company of the year. This is a company that is well run, and we have no doubt that outside the various constraints of government, legislative, and regulatory or legal framework, this company will do even better in terms of execution. So whether we're talking about diversification or enhancing the growth of the core business, we have all confidence and every confidence in the management and to the ability to actually execute, because one of the risks will be coming from, okay, you've told us all these nice stories, they're yet to be tested, these are assumptions. We are showing the past to say that the performance we've witnessed can only be better with an elevated governance structure where minority investors are protected, as highlighted by the CEO. Forex at times is listed as a risk. We want to assure Kenyan that this company does not run a Forex risk, because 52% of its revenue basically is generated in the USD, and that provides what we call a natural hedge to Forex risk. So we don't see that. What perhaps we should talk about is what you call the environmental risk, looking at the past and into the future. But the good news is this. I think before we even talk about a risk, environmentally, KPC is actually the greatest solution provided to our society when it comes to ESG. Because the CEO will tell you that taking this fuel from Mombasa to Nairobi actually is taking off 30,000 trucks the road daily. So even in terms of the environment, I think the business model is such that it is safer, it is cleaner from an environmental perspective. Of course, there's been history around environmental risk. I can tell you through due diligence that was conducted that the framework, the systems, the control that are put in place are such that we are very confident as to the company's ability to navigate that particular risk going forward. Last but not least is regulatory, as IPRA is mandated to discuss and approve tariffs. And really for us, we feel the engagement with IPRA would be even more productive now that government will be divorcing itself from being the player and the referee, where EPRA now will be purely playing a regulatory role in this particular context.
Give us the key dates and then invite people to come and join the process, and then also tell them where to buy. Give them a quick pitch on the key dates, the key things they need to remember, and where to buy.
We have about 10 days to go. This offer opened on 19th of January for 30 days, so it's closing on 19th of February. We really want to appeal to Kenyans that we made this offer electronic so that it is possible for anyone, anywhere, anytime to actually access the opportunity either through a USSD code or an app. The USSD code, I'll repeat it here, is star 483 star 816 hash. Okay, so if you go the USSD route by dialing in, and then you'll be directed as to how to proceed, believing that you have a CDS account. For those who do not have a CDS account, in the coming days, the app will actually offer an opportunity to apply for CDS account, and within 2 hours turnaround time, you should be able to have that. Meanwhile, we encourage Kenyans to approach their stockbroker or the investment bank for that purpose. So we have 10 days to go. And then we are looking at this EIPO as an opportunity for anyone to go into that, either USSD or the app, and apply and proceed with the application. Now, what happens after the 19th of February? After the 19th, we have a couple of days to process the various applications, and results will be announced on the 4th of March. So the various allocation pool that we've talked about, we'll be coming back and telling Kenya that this issue, of course, all indication that it will be fully subscribed, if not oversubscribed. This issue has been fully subscribed. These are the results across pools, and you'll be receiving a notification either by email or text messages as to the status of your application as at 4th. For those institutional investors who would have gone the irrevocable bank guarantee route, that means that they will not have paid at the point of application. That means on the 5th of March, those IBGs, as we call them, will need to be settled with the receiving banks. That's on 5th of March. And then on the 6th of March, we will be crediting the investors' CDS account and, of course, processing a refund in an event where we have to process refunds. And then shares will start trading on or about 9th of March. But then again, I want to tell Kenyan that's not the end of this process. That now opens the door to a new down, which is now the post-IPO discussion. So really, I want to summarize the key dates. We started on 19th of January, the offer period running for 30 days, closing on 19th of February, a few days to go. So really, time is not with us. And then we'll have results announced on the 4th of March. We'll have those who have gone the IBG route to pay on the 5th. And we will be having crediting of the CDS on the 6th. And trading will happen on the 9th of March, where you will be seeing KPC listed as the 5th largest capitalization at the Nairobi Securities Exchange, just after Safaricom, KCB Equity, and EABL. That is what we're seeing in terms of timeline. And I want to assure Kenyans that those promising that the price will halve post-IPO, that is pure speculation, because we have no reason to see that happening. Given the demand that we've seen across pool, our belief is that post-IPO, there will be significant activity at the secondary market level, where what we expect is a rally in the price. And from a company perspective, the CEO will tell you a lot is being done to ensure that day one post-IPO, the company is fully compliant with the CMA regulation. Of course, the scrutiny will increase, and there's a team that has been put together to ensure transition, compliance with CMA regulation. And going into the future, there will be significant announcement when it comes to material impact to the financials of KPC.
Have you gotten some guarantees from fund managers and all, or the key investors that you're targeting, to say that they are actually going to subscribe?
Let me give you a fact that you can check with me a few weeks from now. As we speak today, we conducted what we call a direct engagement, which is book building, with all our significant investors. I can confidently tell the country that as we speak, we are 80%, if not above 80% subscription rate, okay? We do not want a situation where last minute we see a couple of Kenyans challenging the system. And when I say 80%, the challenge, what we've seen, Eric and team, is some cold feet on the retail segment. Yet, as our objective was really to launch a charm offensive to the ordinary Kenyan and ensure that they are part of this ownership journey. So really, the reason we are here tonight is because much as we are confident that we'll be fully subscribed, we feel that we won't achieve our objective until and unless we have as many Kenyan participate into this issue. This is a historic opportunity. Let's look beyond dividend. Let's look at growth. Let's look at that child of ours, our sisters, our mothers, and say, how do we give them a future that is likely to grow, a future that you can share? And I want to tell those in the room that Valentine's Day is just around the corner. What a better to surprise your loved one with a few shares of KPC. I think that's the right thing to do. I would encourage anyone to take that opportunity to go that route.
Someone is asking whether we are doing an international roadshow to maybe rope in more investors. Are you doing that?
The answer is yes, post-IPO. What we decided, and that was a policy decision, was at the end of the day, when you go back to the sessional paper, we were given 3 objectives: raise non-tax, non-debt revenue to the exchequer, broaden the base of ownership of KPC, and unlock the potential of KPC. Now, when it comes to broadening the base, the task is daunting. It is a challenge. And for us, looking at the demand, we were confident that because subscription will be pretty much full, we should achieve an objective that has been given to us, that is focusing on retail. So we've deferred the conversation on international roadshow. Deferred is the word. We've not cancelled. We've deferred that conversation so that post-IPO, we continuously engage the foreign investors as a way of stimulating demand post-IPO to sustain the price. So we are seeing some of the market, I can say it here, we had planned and we still plan to be in London at some point.
You have an allocation to the internationals. So how are you getting that allocation taken up if you're not doing a roadshow for them?
COVID has taught us that roadshows are not always physical, isn't it? So today I spoke to, and Joe will tell you, we've been on phone with international investors throughout. We had investors from the US speaking to us today. We had investors from Dubai speaking to us. Roadshows for us, it doesn't always have to be physical or in person. And we've actually received some strong indication that some of these investors are coming in. So on the international poll, we think and believe that the 20% will be fully taken up. But that's not the end of the journey. We still believe strongly that we need to stimulate demand post-IPO. We want to engage with them. We want to tell them the KPC story going into the future. And that is why those capitals, be London, Riyadh, or Dubai, the US, or Joburg, we still plan to reach out to those investors as a way of sustaining the momentum around the KPC story.
Joe, someone is asking about your CapEx plan. If I look at the numbers that you shared, you have a plan to spend around 110 billion in the next 5 to 6 years on CapEx. What exactly are you investing in that regard? And if I compare that to the 2025 and 2024 number, looks like it's around 5 billion in CapEx. So what motivates that big jump in CapEx? And then how do you commit to finance that? And then at the end, you can share the investor relations contacts for KPC because someone wants to reach out.
Out of the 110, I talked about the diversification as well as enhancing the existing business. So the first one is a line from Mombasa to Nairobi. We'll be putting up a new line, and this will be, it's called line 7. That will take the bulk of it. We did line 5 in 2018. So that's close to about $500 million US. And that was combined between debt and equity, 70-30. So we went out there and we borrowed $350 million US. And we financed 150 from our internal retained earnings. So the line 7, this line will be able to supplement the increasing demand, especially coming from the region. Today, 52%, as I said earlier, is the market we are serving for the larger East Africa region. We expect that number to increase to close about 60% in the next 5 years. And with that increase, we then need to increase our supply to meet the demand. So line 7 is a big one. And also that line will act as a redundancy line. Today, we only have that line 5 from Mombasa to Nairobi. With line 7, should then be able to act as redundancy. Number 2, we are looking to do the line from Eldoret to Kampala. And on our side, we've budgeted for Eldoret to Malaba because they want the government to invest on their side from the border to Kampala and then later on to Kigali. So this is the Eldoret, Kampala, Kigali line. And you'll see in our information memorandum, we also have that line giving us revenue stream, which I spoke about earlier. So that's the number 2. Number 3, we are looking to invest, setting up storage capacities and the evolution of the LPG, mainly in Nairobi as well as Eldoret, and that will take a part of the CapEx as well. And the last one is the trading up for Kenya Petroleum Refineries. I talked about earlier. Today we are serving about 5-6 markets. We want to serve close to about 12 markets all the way down south. So those are the big ticket items. And this is the information that we've shared in the IM that will constitute the other than 10 billion. In terms of where that money will come from, again, it will be a combination of debt and equity. I talked about earlier. We then be able, in the new dispensation, to access cheaper capital in terms of the funding options. It could be a rights issue, the bond issue. So all that should be taken into account. And I'll tell you, when we borrowed for line 5, the $350 million US dollars, it was a 10-year loan with a 2-year grace period. We were able to repay that loan before the 10 years. And therefore, at even the rate that we got, I think we got about 4.5%, which was even cheaper than the one the government of Kenya got in terms of the Eurobond. So on the strength of our balance sheet, we believe we'll be able to access cheaper debt to support us finance these projects. So in a nutshell, it will be a combined between equity and debt.
The CapEx conversation, to add to what the CEO has said, is it's not extraordinary. If you look at the past 5 years, this business, KPC, they've actually incurred CapEx of about 95 billion in the past 5 years. So 110 billion going forward, and nothing new. And he's talked extensively about line 5 CapEx that was incurred and the loan, etc. So I just want to tell the analysts that for CapEx, it's not just about the forward CapEx. Let's also look on the history of that CapEx. Again, forward look, there's development CapEx and maintenance CapEx. So if you look at most of the bulk of this CapEx is development CapEx. So it means this is CapEx that is actually going to yield revenue. It's not purely replacement of existing assets. So when you look at the Malaba line, for instance, the top 3 CapEx, we're talking about line 7, Malaba line, and LPG. Line 7 being around 35 billion CapEx, Malaba 24 billion CapEx, and the LPG around 12 billion in Nairobi, and then 3 billion in Eldred. So combined, that's your top CapEx. And then all that is bringing in a revenue. So if you look at Malaba line, once you operationalize that, it's adding an additional 4 billion per annum revenue into your top line. So I want analysts to look at CapEx from a historical point of view to see that it's not extraordinary, but also from a development versus maintenance CapEx, and looking at the revenue that's yielded from that particular discussion, where we can actually say the ROIC, that's the return on invested capital of the new CapEx or the development CapEx, is higher significantly. So I just wanted to bring in that particular context in addition to what the MD has said.
Thank you, Belgrade. So now, gentlemen, closing remarks. We'll start with Belgrade. You give us your closing thoughts. Please make sure to reiterate the key points, key dates, and key things that people need to remember and take away from this conversation. So we'll start with Belgrade, and then Joe, pitch to the investors why they should join in building Kenya Pipeline to what you want it to be in the near future.
My take is that as lead transaction advisors, I want to assure the investing public that significant due diligence was carried out to this particular issue. So the disclosure that you've seen in the information memorandum is accurate. The projections are fairly accurate. And in terms of value proposition, we strongly believe that this is a unique opportunity for investors looking at balanced return where you're able to earn dividend but also take an upside on growth. This is a unique opportunity. Let no one really stick to the dividend side of the equation. The total return of KPC from an opportunity cost is significantly higher. We've talked about maturity of this asset, 52 years old, strong record of performance. We're talking about a dividend track record of 24 billion over the past 5 years. Going into the future, we're seeing 50% dividend payout. So for any investor looking at the best of both worlds, that is the dividend play and the growth, which is a capital appreciation, we would tell you without fear of contradiction that this is a significant opportunity. We've looked at the growth, we've looked at the margin, we've looked at the value prop, high growth, high margin. That means in terms of impact, we're pretty much confident that the cash-rich debt-free balance sheet that we're talking about is likely to yield even more going into the future. We have 10 days to go, Kenyans, and there are 2 ways you can apply. Going through the USSD code, I'll repeat it, *483*816#, but also the app that is kpcipo.e/offer.app. I would encourage Kenyans to visit those particular platforms. We have 10 days to go, so on 19, this offer is closing. Let's not wait till the last minute to rush. Let's also not listen to the unqualified. I think people have talked about reports being issued. We've seen a spectrum of reports. And if you go by the recently released reports, whether it's by the Standard Investment Bank or the Capital A, you'll find a very neutral approach to value. And then I want us to refer to that. 10 days to go. Let's go through the USSD. Let's go through the app. And then on 4th of March, we'll be notifying you about the results. Be part of this journey. Don't be left behind. Allow your loved one through Valentine to own a piece of this regional strategic asset. The future in terms of growth, in terms of margin, looks bright and is a future that you can share. And we're happy as Fido Investment Bank to take you through the process of investing. Reach out. Our teams are available to assist where they can so that you're part of this history. On that note, I also want to thank Mwango Capital for giving us this platform to explain to Kenyans in plain language what we see as an opportunity, which is historical. It is the largest in the region. It is electronic. And then we're proud to facilitate you into being part of that future. Thank you.
Thank you. Joe, over to you. Speak to the investors directly now.
Thank you very much. And for the investors, this is an opportunity of a lifetime. This is a company that is run by highly skilled employees. It's been around for the last 52 years. Fundamentals of this company are very strong, consistently delivering great business performance year on year. For our growth plans in the future are very solid, and therefore I want to encourage you as a potential investor, put in money in the company and you'll be guaranteed. This company is highly profitable. We are the leverage. We've talked about cash fresh. We don't have any debts. We are the only refined petroleum products in the region. And last year, we were the company of the year. Overall, we beat everybody else, second to none, in terms of leadership, in terms of agility, and you can imagine the sky is the limit. We did that with a state corporation. And now moving on into a PLC, I'm sure we'll be competing with the best in class in Africa, even in the world. And therefore, it's an opportunity that guarantees your future. You need to be part of this inspiring story. You need to be able to tell your kids and your grandchildren that you invested in a company that is able to pay for your retirement. You sit back and wait for the return. I can assure you the team in Kenya Pipeline are agile. They are ready to deliver for you in the new dispensation, and we are able. And therefore, the opportunity to invest is now. Invest today and share the future with us. Thank you very much.
Thank you, Joel. Thank you, Belgrade, for joining us for that 1.5 hours. We meant it to be 1 hour, but we had a lot more questions. It speaks to the interest that Kenyans have in this IPO. It's one of the biggest after, I think, 2008 when Safaricom was listing. So wish you all the best. Hopefully we'll host you after the results to celebrate that. And also we'll host you in the near future when you're reporting. Will you be semi-annual, quarterly, or what should we expect from you in terms of results, by the way?
So the results will be in line with the CMA. We'll basically be reporting on a half-year basis. And I'll tell you, the performance for half-year ending December at Digits is nothing but inspiring. This will be the best year ever. And finally, I really want to thank you, Mwango Capital, for bringing this to Kenyans, for us to share the story. And I also want to thank each and everybody on this call today for having sacrificed your time to listen to us so that you are able to listen to the story of Kenya Pipeline. The untold story. Now you are enlightened. Come and invest with us. Thank you.
Thank you so much, all the listeners, Belgrade, Joe, the teams from the various companies involved in this. We want to thank you for taking your time this evening to join us on these spaces. So to participate, we'll share a few more details on our timeline. If you just Google Kenya Pipeline IPO, you'll definitely be taken to the website where you can actually apply directly. And then the USSD is *483*816#. You can just get to participate in the process as quickly as possible. So you have 10 days to do this. So we invite you to join in that process. Thank you.